Welcome to the Remarkable Retail Podcast, the only podcast hosted by two of the NRF's top retail voices. I'm Michael LeBlanc.
And I'm Steve Dennis.
We have a very special episode for the people this week. Not only are we joined by the one and only Kevin Ertell as our guest co-host, we also have an interview recorded live from the Narvar podcasting studio at the NRF Big Show in New York with two of the top international thought leaders in retail from one of the top firms in the world, EY. Malin Andrée, partner, global retail industry leader, and Jon Copestake, global lead retail analyst, EY Insights, to unpack the latest findings from EY's Future Consumer Index and what they are hearing and seeing on the front lines of global retail. Kevin, welcome to the co-pilot seat.
Thank you, sir. It's great to be here. Long-time listener, first-time co-host, I guess.
Really looking forward. None whatsoever. But we're really looking forward to you weighing in on the various topics we'll get into. But maybe before we really jump into things, why don't you tell our listeners a little bit about who you are, what you do, and you've also got a relatively new book out. So maybe just a little bit about what that's about.
Yeah, sure. So a longtime retailer, my whole career in retail started on the shop floor when I was in high school at Tower Records and spent 20 years there, worked my way up to senior vice president, where I led the team that built the first TowerRecords.com. So been involved with all that really early on. Worked at other retailers since then. I was at Borders, where I led the loyalty program there, Borders Rewards, as well as Borders.com. Also spent time as chief marketing officer at Online Shoes. I was at Sur La Table, where I did digital marketing and tech. And then 7 years at Nike, where I had a variety of different roles there, everything from leading the digital business globally for running, leading overall digital operations globally. And then the last 3 years I was there, I led global retail operations. So everything we were doing was stores with Nike.
Where are we finding you today, Kevin?
I am in Cleveland, Ohio, where I moved back to after leaving Nike and starting my own business. And Cleveland's where I'm from originally. So happy to be back here again with family, and got my new business, Mystere Advisory, which is focused on helping companies with executing strategies, which, as you mentioned, Steve, is what the book is all about. So the book is The Strategy Trap, Why Companies Fail at Execution and How to Get it Right. And it's kind of an operator's guide to how to make your strategy come to life. I focus on a system I put together called the 6 C's that people can use to bring their strategies to life. I try to make it really practical and useful. And my operator point of view, but I talk to lots of other operators too, including a certain good-looking guy right here on the podcast.
Stop talking about Michael. I'm right here looking at him.
All right. Well, this is exciting. I'm very excited for this episode, as always. And like I said, welcome aboard. Don't forget to stay tuned for the listeners after our interview with Malin and Jon. We'll be hearing Steve and Kevin's take on the remarkable story of the week and what is on their radar screens. Let's get to the news and start where we must. Kevin and Steve, we're over a week into one of the most significant global events in a decade. This year, and it's only March, a lot of significant global events. Talk about your early thoughts on the impact of the American international retail sector of the Iran war. Steve, you go first, then Kevin, pile in after that.
Yeah, well, one thing I was going to say, we've talked about this a bunch, but more so in the context of tariffs, but longtime listeners will know I talk about this thing called VUCA, which stands for volatile, uncertain, complex, and ambiguous. And I feel like this is just all adding to more volatility, more uncertainty, more complexity, more ambiguity. So that's not great. Specifically, of course, if this is to continue, the conflict and some of its disruptive impact, well, we've already seen just last week, oil prices skyrocketed, a lot of other costs like shipping costs are going up a lot. 20% of the cargo goes through the Straits of Hormuz. So with that being shut down or not operating at full capacity, that starts to have potential ripple effects in terms of product not being available, but generally costs going up. Oil prices, obviously very important to whether consumers have money to spend. But of course, oil touches everything, right? Airline prices going up, freight costs going up, et cetera. So this could be quite significant. How long it lasts, I guess, is really the big question. I'm not about to predict what that looks like. But at least in the short term, it's quite disruptive. I've even seen some people speculate that this could cause a recession. I don't know that I would go there quite yet, but it's definitely something that is quite disruptive.
Kevin, as an operator, you're used to having exogenous things happen outside of you that you have to deal with. What make you view this one?
Yeah, and this one is definitely concerning for all the reasons Steve said. And when you see gas prices go up, it's less discretionary income for consumers, and that hits retail really quickly. So I expect to see a lot of that impact. The uncertainty side of things is also critical. To Steve's point, I expect that it's going to end up leading to more layoffs and more hiring freezes, and all of that ends up cycling and again coming back to hitting retail because people are more cautious with where they're spending their money, particularly discretionary income.
Well, I can tell you here in Toronto, we're pretty far from the fight, but I filled up my F-150 this morning, and I practically had to get a home equity loan to do it. Gas prices jumped up like 10 cents a liter literally overnight. So, all that money that goes into the tank, Kevin, to your point, that comes out of particularly people at the value end of the spectrum. That comes out of discretionary spending and even comes out of essential spending. All right, let's move into our earnings segment. What did we learn from quarterly earnings reports this week? Steve, kick us off what you heard and saw from our friends at Target.
Well, first, I'll just make a general comment, which is there were a lot of earnings last week, and we are not going to go through all of them. So there'll be a number of major retailers that we're not going to talk about. I guess my general comment would be that, just as I kind of look back, is what we talk about is the great concentration continues. I'll get more to that when Costco comes up. Stampede to value, a lot of the value-oriented retailers, off-price retailers continuing to do well. Several retailers, including one we'll talk about in a second, pointed to tariffs providing meaningful headwinds. We haven't seen as much of that in earnings releases, so that seems to be kind of feathering in more. And I would say in general, just about everybody, though one of the retailers we'll talk about doesn't seem to be very worried about this, or if they were, they didn't say anything about it, but there's a general slowdown in spending. But Target, of course, was probably the one that had the most interest, not only from what they reported, but what their strategy is going to be going forward. So Michael Fidelki, I think I finally figured out that is the way you say it, because that is what Sarah Eisen said when she interviewed him. So I'm assuming they've gotten that right.
Now you got to get Sarah's name right. So, the
I
journey
know,
continues.
Right.
No, we can't. I can't get everything right, obviously. So there were results, and then there was the Investor Day presentation. So just touching on both of those really quickly. As far as the results, it was yet another quarter of significant comp store sales declines. I did separately look at some CoreSite research that kind of talked about the gap between their performance and the industry more broadly. Michael, you and I have talked about it in relationship to Walmart's performance, but this gives a little bit broader view. So what CoreSite said is, if you look at Target's last year performance in apparel, their sales fell nearly 5%. The market was up 4.8%. So that's a pretty big gap. In beauty, more or less, Target sales were flat. The market grew 5%. So we're seeing just these humongous gaps. Obviously, their strategy is to try to turn that around. They weren't super optimistic about the trends changing in the short term, but given how much work they have, and I'll let Kevin maybe get into a little bit about this in a second, but essentially their Investor Day presentation, I guess I'll say it said a lot, but I'm not sure how much of it was very specific. I think they said a lot of kinds of things that, you would expect. They would say, we're going to reinvest in our stores and our associates. We're going to go back to the success that we had in the past by getting more focused on the things that made Target great before. There was a little bit more about kind of the edit to amplify strategy. I'm sure Kevin knows about that from his Nike days, where they're getting more focused in certain areas, emphasizing private brand. But, these are a lot of things that Target has been doing for a while. So I guess, ultimately the proof is in the pudding. It all sounded pretty good, but they definitely have a mountain to climb. And as we've already talked about, they've been signaling, but I guess they confirmed some pretty big investments in stores, in technology, in more staffing on the floor. So let me turn it over to Kevin. I'd be interested in his perspective on what he heard or how he just in general feels about where Target is.
Yeah, I listened to the whole Investor Day presentation, and it was interesting. I mean, they talked a lot about a new strategy. They had 4 key priorities they talked about, although the fourth one was a bit of a mishmash of multiple priorities, I think. Overall strategy, to your point, sounded like things they've said before, but didn't sound bad. I mean, they talked about, being focused on merchandising authority. They focused on, store experience. To your point, it was kind of vague. There were a lot of high jargon usage of words that would concern me a little bit when we talk about execution. Now, they did mention execution a few times on the call. I was happy to hear that. But
I know a book. They didn't really. Maybe we should send them a case.
Yes, send them a case of books, man.
Yes, we could. They could use it, so they don't repeat that whole Canada thing. I think they definitely would. I would love to understand better for how they're taking that very, very high level view and actually translating that into action in their stores and in their merchandising teams and business. To your point, they talked about emphasizing specific things, which maybe is edited to amplify, but I didn't hear as much about what they're editing out. It was more about what they're focusing extra on. And I think, you have to be careful not to just load everything on the top of what they're already doing. They talked about investing $2 billion, pretty big investment, but they didn't go into a lot of detail about specifically what they were going to do with that. Although I did hear things that were promising, like focus on store labor and training and that sort of thing. One thing they talked about a lot was delight is the standard. And which sounds really nice on a PowerPoint prepresentation. What I didn't hear was how they were actually measuring delight. What does that mean?
Right. And, I thought the same. Yeah, I thought the same thing. Yeah,
because that's the sort of thing that translates when you're in a store. As a store manager, you can't just tell teams, "Hey, go delight people." It has to be something more meaningful and specific than that. And I didn't hear that. It doesn't mean they don't have it, but they didn't really go into any of that on the call. But I think that will be very important for them if they're going to actually pull this off.
Yeah.
Well, the Target brand has been on quite a journey over the past couple of years. We've had folks from Target on, very impressive people, and but somehow, whether it's the strategy to execution piece, which made us think of you, Kevin, it's basically the title and theme of the book. They've just fallen short consistently. So good luck to them. It's great to hear, and we'll be keeping an eye on them in the future. Now, let's get on to the Gap. So as many listeners know, I worked for Levi Strauss for a while, so the happenings, the ups, downs, and the sideways of the Gap continues to hold my attention. Steve, take us through it.
Well, just real quickly, they've been going through this turnaround. It looked like they were gaining some pretty significant traction over the past 2-3 quarters, I guess, and they are continuing to improve, but the overall results were pretty meh. At Gap brand, the comps were strong. They continue to have poor performance at Athleta, which is a pretty small part of the business. And then Old Navy and Banana Republic were both, more or less in line with inflation, I guess. So that doesn't actually suggest a ton of momentum. I had to laugh a little bit. Not that this isn't a real thing, but they did blame weather-related store closings. And I always love going to the weather was a problem. I have a little bit of PTSD from my Sears days when we would get on earnings calls and say, well, weather was very averse to our lawn and garden business. And this would be like, a week later, Lowe's and Home Depot would come out with great numbers. And I'd be like, man, apparently the weather across the street wasn't so bad.
Different.
But anyway, so, but yes, they a bunch of retailers were obviously affected by some of the storms. But anyway, I think they're the only major retailer that called it out. So sales overall, not great. Profits, though, went in the other direction, and that's never good. I think sometimes when we look at these turnarounds, people focus a lot on sales, but last time I checked, if you're not making any money, it's hard to say that's really a turnaround. And they did point to tariffs being a pretty significant headwind. They gave a relatively tepid outlook. And I don't know, Kevin, if you have a comment on this kind of writ large about how do you separate out what is the macro environment being difficult versus what is specific to you and your strategy and your execution. But anyway, it's definitely a little bit of kind of cold water on the story and momentum that had been building there.
Kevin, question for you. Is there hope for Gap, or is the best days behind them?
I think they absolutely can. Again, it always comes down to somewhat strategy, but much more execution. How are they actually putting all this together and addressing, challenges, capacity issues they might have to focus on the things that are going to matter most to the current consumer. I think we've seen some newer generations sort of embracing some of the Gap brands. So they have possibilities for sure. But, the one problem with old, long-standing retailers is they have built up a lot of bad habits and a lot of sort of debt over the years in habits, not in dollars necessarily,
right.
That they're going to have to change.
All right, let's move on to Costco. Numbers continue to impress. They only seem to go in one direction. Steve, what do you think?
Well, really quickly, we've talked about Costco a lot. I guess it's just more of the same. Comp store sales up 7.4%. Their digital business, which is relatively small for them compared to someone like Walmart, up 23%. Net income up. So, I don't know how much of this is, they certainly execute very well. They're certainly well positioned given the macro environment. I continue to be pretty blown away by how such a big retailer continues to put up such big numbers because it's on a very big base.
All right, now let's move on to On. I didn't know this brand even existed until I met you, Steve, and some of my favorite footwear. And Kevin, you happen to have a little bit of background in footwear and the category. So maybe you could kick us off about what you thought about the On numbers. They seem to be a little bit of warning signs there, but it's come from nowhere and it's a big deal, right?
Well, I think it was interesting. They had lots of strong comps and strong growth, but their stock dropped 14% after the announcement. And that's because their, forward-looking guidance wasn't great. And, On, to your point, a lot of people hadn't heard of them. They got an opportunity when Nike took its eye off the ball in terms of running and in terms of relationship with wholesale partners. On got shelf space, they got in, they made impact with audiences, but Nike's in the process of roaring back, and that's going to be a massive headwind for On as Nike takes more space and puts more dedication back into running.
Steve, any thoughts on the potential for On? Is there a there for them to grow the business, or have they kind of tapped out on that kind of their line of thinking and their lines in the?
I suspect their business will continue to grow, but the stock seemed to crater because of the expectations. But the numbers are really impressive. Sales were up 23%. That is both comp as well as new distribution, including their own stores. Record gross margin, almost 64%. EBITDA margin, almost 18%. So this is a business that is performing very, very well. But like a lot of specialty businesses, you get to a point where you're going to start to see, even irrespective of what a particular competitor does, and obviously Nike has a lot of potential to cause problems for them. But even if that weren't the case, it's just, they have a very particular sort of audience. And so whether they can really broaden the total addressable market significantly, they're adding apparel. There's a lot of things they're doing to try to maybe follow the Nike playbook, basically. But of course, they're quite a bit smaller. So I still think it's a remarkable brand. I suspect they will continue to grow, but I think they're probably getting to the point where that growth is going to come much more. It's going to be much more difficult to sustain the kind of, breathtaking growth they've seen over the last 3-4 years.
Well, all right, that's a wrap on the news. Let's now get to our interview with Malin and Jon, and then we'll be back to hear Steve and Kevin's take on the remarkable story of the week and what is on their radar screens.
Well, Malin and Jon, welcome to the Remarkable Retail Podcast remote studio at the NRF Big Show. How are you guys?
Very good, and thanks for having us.
Sure. Well, we are at the end of the long road. So
you guys look full of energy, bright-eyed, bushy-tailed. You're like ready for another couple of days of this, the looks of you.
We have got another couple of days of it.
Acclimated to the time change, perhaps. But, well, speaking of which, we want to learn a little bit more about who you are and what you do. So maybe we'll just start there. Malin, you want to tell us a little bit about who you are and the work you do at EY?
Yeah, sure. So I lead the global retail sector within EY, and that basically means that I am working with a team to support our client teams across the globe, building the right capabilities, building the right solutions, making sure that we have great insights coming out. Jon is leading the insights team.
Right.
And being shown in the market, also partnering up with a lot of companies that's here at NRF.
Sure.
So it's been intense, a lot of meetings during NRF to catch up with those clients and partners and people like you.
So I'm the lead retail analyst at EY Insights. So effectively, as Malin said, I'm the guy who puts together a lot of the thinking, trends-based stuff, looking at the future, factors like that. So really working to support the practice on taking insights to market so that we can sound good with our clients, I guess.
We met, I think, almost 3 years ago, maybe in Barcelona, where I got dragged. No, I didn't get dragged, but I got cajoled into learning, going back into the bowels of the hotel to see what you guys were working on with something called large language models and AI, which I don't know whatever happened to that.
That's an old trend, right? I don't think we'll see anything.
Haven't heard much about it. So that was a big waste of time, as it turns out. But anyway, no, I'm kidding. But we have a bunch of things we want to talk to you about. But one of the things is this luxury client index study that you guys have put together. Malin, what is that about?
We did a study around summertime, around the luxury client segment, and what are consumers prioritizing in terms of different aspects when they decide what to buy and not. We surveyed around 1,600 consumers globally in 10 markets, and the purpose of that is basically to see how our clients can adapt better to the changing consumer demands. We looked at 5 different customer segments in luxury in totality, and there has been a big challenge for our luxury clients, as you all know. Given private label, the quality is getting better, and the price points for luxury has increased significantly, and consumers are obviously demanding value for money to a larger extent today.
Can you maybe just quickly describe the segments, just for people to kind of have a feel for how you parse that out?
The segment is defined, it's kind of self-explanatory, but there's flexible, prestige, discerning, drifting, and beyond. So flexible, obviously people dipping in and out of the luxury market. Prestige is probably people who really see more status in luxury and are focused in that sense. Discerning are people who are probably being picky and choosy about how they engage with luxury. Drifting are people who are much more price sensitive, much more kind of like, will I buy this item or not? Thinking much more hard about it. And then beyond is effectively people who are established luxury buyers. They spend a significant amount of money on it, and they're the highest income earners as well.
Yeah. When I was, just as an aside, when I was at Neiman Marcus, we called those people absolute luxury, and then we had accessible and aspirational were our 3. So I was a little curious just the difference. But it didn't get into, I like that actually quite a bit better because I think it's a little bit more descriptive.
A bit more nuanced,
Yeah.
I mean, one of the things that jumped out at me in the study was you talk about the resell, the reuse, the secondhand market, and I think that's a market where genuinely luxury is kind of shied away from. We've talked to brands like Canada Goose, who've kind of done it on their own. Arc'teryx has got a great store here in New York where they both repair, which I thought was a really nice idea, that you both have a repair facility, a sewing facility, and the resell facility together. What did the study tell us about the attitude of both consumers willing to buy secondhand? We know there's some appetite, but also how the brands are thinking about it, because I think they would eschew it a little, but now they're a little more welcoming, perhaps. What do you think?
I think from a consumer perspective, I mean, we touched on it earlier. Cost of living is going up. There's clearly a big element on price and making consumers more price conscious. So I think that's one driving factor. But
are those consumers, just as I'm thinking through reflecting Europe, are those even in the TAM, the total accessible market? I mean, I these think luxury brands, they're off shopping other brands. They may not.
No, interestingly, I think the consumer segments we looked at spanned a lot of income groups, and I think aspirational is the right word. A lot of aspirational consumers will still buy luxury and seek luxury. But then the other thing is about market access. Most consumers will want luxury of some kind. They want to purchase luxury items, luxury products, but then the price they might be priced out of it. And I think coming into it, secondhand is driving that ability to get access to those products and those garments.
Yeah.
But then another factor is that the platforms that can do it have really escalated. So the ability to resell through platforms is become much stronger. The ability to verify and check for authenticity is improving.
So on behalf of the customer, they can trust what they're buying a lot more.
To a higher degree, yeah.
To a higher degree.
Not absolutely, obviously. Yeah. And we've seen a lot of studies where maybe customers have been missold or misbought. So it is still an area of a grey area. But then the other thing is, younger consumers, particularly Gen Z, cash-strapped, also sustainably minded. I think there's a lot of virtue signalling now in secondhand. People actually buy secondhand, not necessarily because they have to all the time, but because actually it sends a good signal to the market on their sustainable intentions or keeping things in the market longer. There's no stigma to secondhand as there may have been a longer time ago.
We've both been on the mic before for the Voice of Retail, so I'm going to resurface this for this audience. Is, you know, when I read and I hear about younger consumers focused on the environment and their purchases, I kind of caught a little bit of BS on that, because or else Shein and Temu wouldn't exist, which are the embodiments of like, I just want to keep buying, I can't afford anything, and I don't really care what's happening when those clothes are made or where they go.
Yeah, but I did say virtue signaling, right? So this points to them saying that they're going to do this. And I was actually talking to somebody about this recently, about the notion of two concurrent trends that may be opposites.
Interesting.
They can function in the same space. So consumers on the one hand will buy second-hand, and they'll say, this is because I'm, giving to the environment. And then on the other hand, they might still go to
it's a savvy purchase. It's savvy. So. One of a quick follow-up on that, and then I want to turn to how the brands are thinking about it. But for many, many years, the brands, I think of Nordstrom would have have the rack, or they would have different offshoots, and they would see that as the gateway for accessibility of a younger customer who's buying a more affordable product, but it's an overstock, but still an introduction to the brand. Does one surpass the other in your mind from consumers? Are they more likely they get a double benefit? Secondhand is better for the environment and better priced. The off-market is, better priced, different assortment, a bit of a treasure hunt. Lots of trade-offs to be made there, right?
There are. I think even with the off-market, though, the prices are still very high. Whereas compared to potentially second-hand luxury resale markets, I think that they're more attractive to consumers. And the other thing is that the off-market isn't as accessible. So, the platforms for second-hand are really strong and are very, very prevalent across the whole market, across different countries. Whereas I think for off, you may have to go to a retail park, you may have to go to a certain website. It's a bit more difficult, so the access is crucial there.
And Malin, what are you hearing from the brands? Because we've interviewed Canada Goose, and they're kind of, well, it's about time we got into this. We want to control this distribution.
Yes.
And maybe started to turn their minds from we have to do this to maybe there's an opportunity to do this.
Exactly. I mean, they've been surprisingly slow in adapting to this trend, and this trend is happening right in front of our eyes.
Sure.
So it's not that it's going to dilute the brand. It's actually a way to have better control, as you say, to have the trustworthiness to give the certificate and make sure you secure the authenticity. So we believe there is a strong opportunity here, but we do meet luxury clients that are still skeptical.
Right. But that's the change in mindset that you're articulating, is like a begrudged thing, or we have third parties do it, to like, we're going to actually really adopt this, and we actually think it fits in our customer strategy, right?
You're losing out on that market otherwise. So
I was going to say, is it offensive or is it defensive, right?
Yeah.
If you're going to lose to it. Maybe shift gears a little bit, because you get into a lot of different things in this study. What did for either one of you, I guess, or both, if you'd like to take this on, what did the study reveal about ways that luxury brands can enhance their brand equity, strengthen their brand positions overall?
So first and foremost, quality. Quality came out top of the way that consumers perceive luxury brands, and that's not a surprise, right? Interestingly, quality was seen as much more favourable to consumers than status. So, although in China there's a high degree of consumers who see luxury as being a mark of status, it was less so elsewhere in the world. Obviously, sustainability rears its head in any survey, and so they will say that. Whether or not it's virtue signalling, it's up to them. But the interesting thing for me, for brands, is much more around kind of like storytelling and kind of like being able to actually demonstrate transparently the artisanal work that's gone into it, the quality and craftsmanship. Those are things that I think that, from the study we saw that consumers were looking out for as something that would validate their purchase and give them a reason to spend a premium on it.
We'll be right back with Malin and Jon from EY live on the NRF trade show floor right after these messages. The biggest names in retail don't guess. They use Placer AI. Placer's location intelligence platform turns foot traffic into real strategy, giving you near real-time insights into market share, cross-shopping trends, and trade areas for any location in America. Whether you're entering a new market, tracking a competitor, or optimizing your existing footprint, Placer gives you the data to decide with confidence. Visit placer.ai to see it in action. If the world has changed so very, very much, Why have so many organizations change so little? As the pace of disruption accelerates, leaders need the courage and the insight to aim higher in the value they deliver, move faster than they ever have before, and take the bold action to leap ahead of the competition. With Leaders Leap, transforming your company at the speed of disruption, Steve's latest breakthrough bestseller, you'll discover why so many companies fall into the trap of the timid transformation. More than anything, you'll learn about the essential mind leaps leaders need to make to win the future. Leaders Leap is available just about everywhere books are sold, as well as on Audible and as an ebook on Kindle for just $9.99.
You talked about virtue signaling, and the thing that I wonder about, and having spent many years in the luxury industry, people are always trying to rationalize. Like we used to talk about, the $3,000 handbag carries stuff as well as the $50 handbag, right? But so you have to believe that the quality and the investment, I can use this for a long time to try to justify the price point. But in a way, it's not necessarily status, but it's, you want what you want, and you find a rational reason maybe to justify an emotional purchase. I don't know. Is that a different kind of thing? Did you find that, or is that just something that's really hard to get at in the way you did the
I think in a survey, you'll get rational responses, even though consumers themselves aren't necessarily logical or rational, and they will make emotional purchases. I do think that in that, there's a lot of the storytelling is a big factor, I think, in terms of, them believing that something, that a product is differentiated, is exclusive, is something that is making them feel special. I think those are key factors in any luxury purchase. So I think that you have to take kind of like the irrational with the rational. But one of the key things around secondhand and factors like that is that, consumers are looking to make logical decisions still, especially, the less income you have or the more expensive things are, the more logical you have to be about it, right?
Sure. Right? Yes, it's pragmatic.
The savvier you get. A question about your tradecraft. So you've been doing this a long time, and it's not this issue, but it's many issues where customers say one thing and do another, and there's other ways to get that with transactional data. But, how do you square that? Like, I've talked to research professionals who kind of ask the same question in a number of different ways to kind of try to get at the truth of what people are saying. How do you think about that?
So it's not easy, right? And there's always an intention-action gap. And in surveys, consumers will always say something, and it's usually directionally correct, but the exact metric, it might be a bit overblown on one direction or another. But a good way to do it is to ask conflicting questions. So not necessarily the same question in different ways, but questions that actually might contradict each other, so that you can understand which side of the fence they're falling on. So on sustainability, for example, you can say, consumers might say that they're behaving more sustainably, but then you can ask them what puts them off sustainability, and then they can give you the answers to that. And that gives you a sense, really, of where they really lie.
I've heard of this AI. We've been talking about it a little bit. It could be a thing, as we said.
AI. Can you spell that?
RETAIL. That's how I spell AI. And failure too, by the way. It has got AI in it. But all right, let's get to this. So, we've been talking to some folks from all kinds of different brands who say, the agentic shopping is here. It happened. They quote some number, some in some studies we were talking about off mic, some ridiculous number like was influenced by AI, which is 50% of retail, which is just preposterous, right? But I think underneath that there's this kernel of truth that consumers are now changing the way they search, changing the way they buy. Maybe that influence is more subtle than overt. So talk about the dynamics of AI and retail and consumers and the brand and how the brands are thinking about it. So John, if you want to talk about how the consumers are thinking of it, or Malin, how the brands are thinking about it, how do you want to take that on, this role of AI today?
I mean, from a retailer perspective, 90% of the retailers invest heavily in AI today, and say they're going to invest even more going forward.
Mostly at the, so far, I mean, it's nothing new. They've been doing it for 10 years. Mostly behind the scenes. But in terms of in front of the customer, that's what mostly intrigues me and how they're thinking about that.
And I think if you compare NRF last year to this year, everyone was talking about agentic AI last year, but now you can really see the solutions at scale across all processes, not only front end.
So last year was a trial balloon.
Exactly.
And people saluted the flag as it went up, and now every booth is in.
Happening.
People want it. It's what retailers are buying. You meet with retailers from around the world. Is that what they're asking you a lot about, is how to adapt, my new platforms to the new way consumers are shopping?
Yeah, so we are working with our clients across many different questions aligned to AI. So everything from data governance to security to what's the AI strategy, what are we going to invest in, how do we make sure we get the value out of the investments, building the model in itself.
Renting a model. Renting somebody else's model, right? We heard a lot of that at the show. How are the consumers thinking about this? I mean, I think, if you search on Google, pretty much now you're using AI because the top results are AI, so it's almost like 100% of people who are searching are using AI.
I mean, that influence thing is very interesting because I think that, yes, you can say AI influenced, a significant amount of digital and physical purchase decisions, but where the influence comes in could be from curating results on search, or it could be from anything that the consumer isn't necessarily aware of. And to build on Malin's point as well, about picking the right AI, picking the right solution. You've seen at NRF, obviously, there's a significant amount of solutions on offer. Which of those a retailer picks is going to be kind of $1 million question for how they thrive in the future.
Nobody wants to pick the Netscape of AI platform, basically, right?
But from a consumer perspective, the interesting thing is when it becomes invisible. So at this stage, consumers are consciously using AI for search or discovery. They might be using it to get new products. So obviously, getting search optimization for AI is a crucial thing. But I think that going forward, it's much more about how it might start curating for them, making choices for them, making purchases on their behalf, and how far that should go in terms of where would retailers or consumers draw the line before they start to reject it, or before there's a backlash or a trust issue. So I think that you need to tread quite carefully in that space. It does become a little bit murky in terms of how much you might be engineering consumer decisions for them.
Maybe this is a good pivot to talking about the balance, I guess, or the way to have a hybridization of technology and in-person retail. My first book, I talked about digitally enabled, human-centered as kind of an anchoring point. I think you talk about human-led retail I think it's a similar idea. But Malin, what does that mean? How are you thinking about advising? Because obviously technology is, increasing. The use of technology is increasing at an increasing rate. It's more exponential than linear. So sometimes when we talk about keeping the humanity in retail, that doesn't seem to be necessarily where the direction is moving. But how would you describe that?
Now, we're talking a lot about that in our team, and as AI scale, it's going to become a commodity for everyone. Everyone is going to have the most efficient supply chain or the most individualized offer. So what is then the differentiating factor?
Right, becomes table stakes, not differentiation.
So that's where the human aspect comes in, and it's going to be a key differentiator. So for us, it's also about helping our clients to figure out where do you want to use AI and where do you want to still keep that human touch to create loyalty.
Sure. And is there any rule of thumb, or is that more specific to the particular sector, type of brand you are? I mean, luxury, I would assume, just in general, would tilt more towards
an overall rule of thumb. I would say all back office processes that are not customer facing. There's obviously a lot you can automate and use AI for to drive down cost. And then the customer facing interactions, that's where you really need to consider. So for customer service, for instance, you've seen chatbots being rolled out for years, but it's not working when you really have an issue. You want to have a human person to talk to. Or I do, at least.
And there's an element as well of people considering it to be an either-or argument rather than a yes-and argument. I think the challenge is that retailers need to balance both human interactions, both physically in store or through services, etc. But they also need to focus on AI investment, because otherwise they will be left behind. And even if AI is the new table stakes and they're not at the table, then they're not able to pay.
Yeah, I think it's... Well, I guess I'm seeing a lot of places where technology is enhancing the human interaction, having an earpiece that's connected to AI customer center or something like that, which still keeps the personal relationship front and center, but technology is helping the sales associate take care of that customer in a better way. So I think that's a good example.
John, let's take a look at looking ahead. It's 26. We're January, we're right into the year. What are you seeing? What are you hearing from customers about what they're thinking for 2026? Is there a level of optimism? Is there a level of concern that doesn't seem to be translating into less shopping. What are the kind of 2 or 3 things retailers need to hear from you today?
I think, well,
to have a good year, to have a great year.
It does depend on...
It's all on you, so...
it depends on where you are, right? So there are obviously some countries that are seeing retail growth and a lot of customer positivity. But I think when it comes down to it, at the moment, there's still a very strong perception on price as being a challenge. Mm-hmm. So I think and especially with income levels not matching it, although there's definitely an issue of kind of, I think, confidence in the market going forward. So I think retailers will need to focus on price and how they can address those price concerns amongst customers. And also transparently as well, so to do it in an honest and authentic way. So customers are going to call retailers out probably quite a lot more in the coming year for things that they don't like or things that they don't see, usually related to price more than anything else.
Interesting.
So I think that would be a key factor.
What do you think of dynamic pricing? Let's go there, because AI is going to power dynamic pricing like never before, and can retailers use it for good or evil? I mean, the perception certainly is negative from consumers. You're just trying to get more money out of me than less, but I've talked to retailers who said, well, maybe, in the QSR scene, it's 4 o'clock, I'm going to lower the price because I want to drive some sales. So, but there's lots of legislation going to happen around it about pricing integrity. So how do you think consumers are thinking about it? And then, Malin, I'm going to throw that to you about the possible world of dynamic pricing and all these things. So is that in the consideration for retailers? So
I think regulation will probably be a key factor here. But I think additionally, consumers would embrace anything where they think they're getting a good deal or they can get a good deal. So if you think about dynamic pricing in relation to stock and stock sales and inventory management, then I think consumers will probably be much more willing to go for a bargain hunt, a cherry picking exercise. But I think overall that there is a challenge around dynamic pricing targeting consumers unfairly, and I think that sort of thing will cause a loss of trust.
Do you do any consulting with the airlines? Because they've been doing this for 20 years. Like, it's not like consumers haven't experienced dynamic pricing in a real way every day.
Or surge pricing, right? With taxes.
Sure. It's
agree.
In front of them. They're not hiding it.
But there's a big challenge there with consumers, because this is an everyday thing. Shopping is something that consumers do every day, all the time. For things like airline tickets, then consumers will know when they're traveling that there might be a price premium to pay based on whether they do it in advance, or whereas this is something that consumers do all the time. So I think it's probably much more sensitive to them in terms of the way that they respond to it.
All right. Anything else that retailers should know about what customers are thinking? Let's talk about America, since we're sitting here in New York. Anything in America?
A lot of uncertainty. I think that they probably would want to know that there's some stability in the way that things are going to happen for them. I won't go where or anywhere like that, so that's fine.
Right.
I think
the weather mostly.
Yeah, I think that the notion of customers actually using tools like AI and digital is one thing, but then I think thinking more about kind of what services they could have in addition to that, or what's going to add on, what's going to differentiate for them. That's something we'll see creeping in more.
I'm going to bounce an idea off you. I think as we go down the AI tunnel very, very rapidly, I can't trust what I see anymore on the platforms. The videos are so good, I can't trust it anymore. So trust becomes a very important thing for retailers, and that's their opportunity to somehow manifest that, in their physical store, and then manifest that in their relationships. I think it's a potentially a unique advantage. I
agree. Well, the thing about trust is that retailers won a lot of trust during COVID, didn't they? And then that trust seems to have kind of disappeared again, or certainly eroded a little bit. I think retailers do have a position where they can win back trust. But interestingly, when you say that about AI platforms, then to a degree, how much will consumers care about that? It does really genuinely depend. I mean, some consumers might be willing to take whatever AI feeds them and use that because it makes their life more convenient, whereas others will probably reject that, and they will be looking for something that is much more authentic and trustworthy.
Interesting. Malin, what do you think? What should retailers be thinking about in 26? I mean, obviously, they're all going to think about AI, and they're all going to think about how to use it. They probably started governance, as you say, and kind of work through that, and it's a great asset for sales associate on the floor. So there's a lot of stuff. Above all that, behind the closed doors with your best customers, the ones who listen, I'm going to tell you these 2 or 3 things, and it's going to be pretty important for 26.
There's still going to be a lot of focus on cost optimization, I believe, in the next year. So even if we hopefully see some light in the tunnel soon.
And it's not a train at the other end.
No. Hopefully not.
Yeah.
So that's a top priority for most of our retail clients. Also getting the foundation right. So.
And haven't they done that? I mean, after COVID, the COVID era, everyone figured out, oh my God, I have no visibility in my supply chain. I talked to a lot of retailers who reinvest in their ERPs. Like, we feel like if you don't...
Still a lot of that to be done.
Still a lot to be done.
A lot of retail clients who are... Maybe retail hasn't been in the forefront on doing changes. Other sectors has done it earlier. So there's a lot of ERP rollouts, a lot of getting the data foundation right, setting up the infrastructure and policies and governance. So I think that would be the key sort of focus, I think, for our retail clients to get that right.
So I know we're coming up on our time, and I'm going to throw out a kind of bigger question. But one of the things I've been fascinated by over the years is, and I've found myself saying this when I get in front of retail audiences, everybody will agree that the world has changed a lot, that it's changing ever faster. And when I ask most people, do you think it's likely to change even, if you look at the past 3 years, how much it changed? Do you think it'll change even more in the next 3 years? And everybody's like, yeah, absolutely. And then I'm like, well, why haven't you changed more? And I'm wondering, because you work with so many different, companies in different countries around the world, what does it take for retailers to transform, I like to say transform at the speed of disruption? Why are so many perpetually so far behind? You can point to a few leaders, certainly, that seem to always be at the edge. But I would say by count, 98% of retailers are always behind the curve. And, of course, in many cases, they get so far behind they can never catch up. What's behind that? Do you see that changing? Are you optimistic about
I think
about
it's
the
a
pace
combination of a lot of different things. It's leadership. That's where it all starts.
Sure.
It's legacy systems, old ways of working. Culture takes time to change.
Yeah.
So it's a combination of a lot of things. I do think the change is going to be accelerating even more. We've seen that over the past year only. So we are actually looking into something interesting together around how is AI going to shape the future of retail?
Sure.
And what are the different scenarios that might play out?
Right.
So and it's quite fundamental questions. Is retail going to be disintermediated, or
it's got to be the fear of that. If you got all these,
how's the power shift going to look like going forward? So,
all right. Well, that'll.
It gets fairly dystopian. And utopian, we do both, right? So.
Which
Awesome.
which presentation do you want? Do you want the dystopian presentation?
Exactly.
Or do you want the optimistic presentation?
That's right. This is why I don't get hired as a motivational speaker. So pretty much most of my stuff is pretty dystopian. So if you
and
want
that's where the interesting discussions are, because different peoples have different views of how the future is going to look like. So there's no one can predict the exact
We used
future.
to call them Chicken Little slides whenever we presented. When the ceiling falls in, this is what it's going to look like. But it's not, or maybe will, anyway.
But on the change front as well, there's a difference between appetite to change and ability to change. So
Sure.
I think retailers do have an appetite to change. They do want to do it, but they have a runway, right? People still need clothes, they still need food, they still use retail for those things. So there's a little bit of time that they feel that they have, even if they don't. And then additionally, there's money. They need a lot of money to change, and I think that's one of the challenges that I think retailers probably have, is that if you're reporting quarter to quarter, and you need to invest in AI, that new thing, right? And then also fix your back end, fix your front end. There's a lot of problems. A lot of organizational capacity gets constrained by that.
If they want to get in touch with you and tap into all this wisdom, how do they get in touch and learn more?
They can find us on LinkedIn.
All right, you're
Just
both on
send a
LinkedIn?
message. Yes,
or on EY.com.
Or EY.com, all right.
Under retail.
Under retail, yeah, that's a bit of a. I've done that. That's a bit of a rabbit hole. So let's just say, let's just say LinkedIn. Listen, thanks again for joining us, and safe travels back home.
Thank you so
Cheers,
much.
Thank you.
Thanks.
All right, we are back, and that was the last interview from the Narvar podcasting studio at the NRF. So that's been we had a great run there. We got lots of great interviews coming up. Let's get to our remarkable stories of the week. Steve, you go first.
Well, I'm going to try really hard not to get too in the weeds on this, but there's a little bit of detail that I need to provide. So Simon Property, we've talked about a few times, and one of the stories we talked about a few weeks back was I was surprised to learn that Simon Property Group, the largest mall operator in North America, had made a $100 million equity investment in the ill-fated Saks Global deal. And I was scratching my head a little bit about that. Well, we've learned a little bit more. And it turns out maybe there was some sneaky genius here on the part of those guys. Now, they are writing off that $100 million investment, so that's not awesome. But it turns out that in exchange for investing in that deal, they got a waiver on something, and I know this is very inside baseball, are these clauses that basically allow mall anchors predominantly to be able to stand in the way of anything mall operators would do. So if you go back decades when you were trying to attract the Nordstroms and the Neiman's and, all these major anchor department stores, they had a lot of power, and developers were willing to sometimes contribute to the build out of their property, give them very low rents, et cetera, but also some rights. Well, it turns out that Simon said, we'll do this deal, but these particular clauses you have to vacate. The so-called REAs is what they're about. Anyway, that is now going to allow them, and it turns out this applies to 57 Simon properties, 7 of which include both a Neiman Marcus and a Saks Fifth Avenue. This is long, just as an aside, this has long been very frustrating to a lot of mall operators, because these deals that were signed often, 20, 30, 40 years ago, where they made a certain amount of sense, don't make so much sense anymore. And of course, a lot of malls need to be redeveloped. They need to bring in different tenants. Well, if the mall operator didn't like the particular tenant coming in, they could just say they can't sign a lease. Or if the mall operator wanted to maybe bulldoze something, put in some restaurants, well, the department store could say, no, we don't want to, or get something out of it. And so it really, really has been gumming up the works. So this now frees, irrespective of what happens in bankruptcy, Simon Property Group to not have to get the Saks Global approval for making any of these changes. Now, was that worth $100 million? I don't know. But I guess this is just an example of where, like, I don't really know what these guys are doing. That seemed pretty dumb. Well, maybe not.
Maybe. Well, Simon says, strike that line out of the contract. What does Kevin say about a remarkable story of the week?
My remarkable story of the week is maybe a little more under the radar, but Walmart announced that they're rolling out digital shelf labels to the rest of their stores. They've been testing it in some stores, and they're rolling it out everywhere. We tested those and worked with those when I was still at Nike in Europe, and I actually think this is a huge deal. Digital shelf labels have gotten to the point where the price of them is economical enough that you can, widely scale them in your stores. And the benefits are pretty huge. Some of the more obvious benefits, you just save labor costs, right? So, repricing product, whether that's stickers or labels on the shelf, is a lot of labor. So you get that benefit, but it also starts to enable other things like better dynamic pricing, really. And largely around markdowns is where that happens. We were doing it at Nike in outlet stores, but when you have to factor in the cost of labor every time you're going to do a repricing, it affects the pricing you do and the frequency you do of price changes. When you don't have to do that, you can be much more frequent with it. So that's a second piece. The third piece I talked about that I thought was really interesting too is using them, I think largely in the back of house, but for fulfillment, so that they can basically have easier fulfillment, find items on the shelves easier for their omni-channel or digital, fulfillment as well.
Right. I know at Canadian Tire, you can, as a customer on their app, you can make it flash. So in a big sea of items or products on a long aisle, you can go find it, right? Is that what you talked about?
Yeah, I think the way I understood, I think they're doing it both. They're using it on the sales floor for that kind of thing, but also in the back of house where you can identify things and operate a little bit more like an actual warehouse works.
Right.
Both of those are good. Those are things we had talked about using them for at Nike as well. I think that technology is going to explode and get used in a lot of places because there's a lot of benefits to it.
All right, let's move on to what is on the radar screen. Steve, kick us off.
Perhaps this is obvious. I think what's going to be some of the repercussions or continuing repercussions from the Iran war, and particularly whether the Straits of Hormuz. I never thought we'd be spending so much time on this little part of the world. But if we don't get more ships moving through there, if more oil, actually even some of the refineries are shutting down because they have no place to store the oil that they're producing. I mean, that can be very, very significant. So, I don't know if this is like literally a day by day thing, but several weeks of that continuing will be very, very significant to the world economy and to retail in particular, I think.
What about you, Kevin? What's on your radar screen?
So I went a different angle. Back to Gap a little bit. I'm a bit of a loyalty program geek, having built one back in the day. And Gap announced some pretty big changes to their loyalty program. They're continuing on the points program they had, but they're adding some extra tiers that I think are interesting around early access to product, limited events, different things that higher end members could get access to. So back to your early question about Gap and what are they doing? Do they have a chance? Well, I think they're doing some different things with their loyalty program around their best members that might further engender people with the brand. And I think it's worth watching to see what they do with that program and how they grow it.
Well, that's a wrap on this episode. Kevin, thanks so much for joining us as our guest co-host. One more throw for your book. Tell us what the book is called and where people can find it, and how do people get in touch with you?
Thank you. Yes, the book is called The Strategy Trap: Why Companies Fail at Execution and How to Get it Right. You can get it at pretty much where books are sold, but certainly Amazon, Barnes & Noble, Powell's Books, those sort of places. You can get in touch with me through my website, kevin@misteradvisory.com. That's MISTERE advisory.com. Or LinkedIn's always good too.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.